Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm here today at KPMG with John Kensington, who's the Head of Financial Services, and we're here to talk about the annual Financial Institution Performance Review for 2011. Thanks for making some time for us, John. Now obviously the deleveraging theme has continued at pace through 2011 into this year, as far as we're aware. What's really driving this, and what, if anything, will bring it to an end?
I think what's driving it, Gareth, is that during the global financial crisis, people in New Zealand, like all around the world, got a fright financially. And what happened was some of them were faced with losing their homes or losing their businesses, and maybe had to sell assets in order to repay debt. And so they've had a large fright. Others, unfortunately, lost investments and were hurt that way. And so what it's meant is that people are very much more cautious with the money that they have. They don't chase yield so much. Security is very important to them now. So they're prepared to put their money into a bank deposit instead of some other form of investment, because that bank deposit gives them security. We've called it a flight to quality. And in effect what they're saying is, I'd rather earn 4%, get a lower return over the life of the investment and get all my money back, than risk having a higher return during the life of the investment but losing some of that money over time. So really what it is, it's people saying, I borrowed too much, I need to stop borrowing, I need to only spend on the things I need to, and I need to be more cautious. Now what's going to turn that around? That's a very, very interesting question. It's going to need an economic uplift of some kind. Now, one thing that might cause that is, or will cause that actually, is the Christchurch rebuild. When that comes online, just the sheer amount of money that insurance companies will spend rebuilding properties, and the way that will filter through the entire economy will cause buoyancy, which will make people a little more confident. It's also important that our rural sector performs more, and that will put money back into the economy. But really it is around confidence. I think people will only start to spend again and stop deleveraging when they are confident. Also too, as a nation, New Zealanders do need to save more than they have traditionally, so that will put increased pressure on to keep that deleveraging going. Now, you've mentioned it's gone on for 2 years. How long might it go on? I would say at least another year, if not maybe another 2.
And we've also seen that lending growth off the back of that at the banks is very weak, around 1% over the 2011 year. Obviously, they're taking in maybe about 6-7 times that in deposits. Just how weak historically is lending growth looking at the moment?
Okay, I think if you go back and look from 2002 to 2009, we saw meteoric lending growth. If you look at the graph, it goes up fairly steeply. 2009, 10 and 11 have been fairly flat, and this would be one of the weaker years that we've surveyed, certainly.
On the other hand, the bank's profitability, certainly at a net profit after tax level, has been very high. We've seen ANZ and ASB, for example, with record net profits last year. Just where does the overall figure for the banking sector fit in from 2011 in terms of the net profit?
I think the actual gross number, if you like, for the sector, which is adding together all the bank's performance, is the highest. When you look at it compared to return on equity, there are higher years where the return on equity has been higher, back in 2005 and 2006.
And in terms of return on assets?
Return on assets, it's fairly stable around the 1% mark. It doesn't fluctuate a lot around the 1% mark.
Obviously, a couple of big drivers with that have been falling impairments on loans, and also increasing interest rate margins with driven largely by the big switch from mortgage holders from fixed to floating mortgages. How much further have those two things got to run, and where do you see bank profits going from here?
I think bank profits are going to be very much at a level they're at, similar to where they are now, provided that the debt impairment can still be managed. Now, the banks have done a tremendous job over the period since the global financial crisis managing their problematic loans. They've done it very carefully in a very orderly manner, and that has seen them take more time to work out some problem loans, and it's seen impairments come down. Impairments are still at a high, and there is still room for them to come down further, and so hopefully that will happen. In terms of how things are looking for them going forward, there is still some loans that are fixed to roll off onto floating, but the benefit they've had from that roll off is getting towards the end.
So we're probably looking from here the next year or two of flattish profits?
I think that's probably a fair assessment, yes.
And what about the funding side? Obviously much has been made of the drive to reduce the New Zealand bank's dependence on offshore funding. How are they faring on that front? And obviously the Reserve Bank's core funding ratio is currently scheduled to increase from 70 to 75% at the start of next year. Are they ready for that?
Yes, I think they are. Firstly, yes, I think they are ready for that. And as far as funding goes, there's been a lot of dynamics in play here. Back at the beginning of the period of our survey, there was very competitive tension in that deposit market. And as the banks got toward their quota and in fact over the core funding ratio required, some of the pressure came off. And then later on during the year, more pressure came off because there wasn't simply the request from borrowers on the other side of the balance sheet. So that is something that the banks have managed well. It's going to be something they need to continue to manage well because of the increase that you've alluded to in January, but also the rating agencies have made it clear that while they've made significant progress, they still feel that the banks, the New Zealand banks, are very reliant on foreign funding, and should problems occur in those markets, it would be problematic for the banks. And so there's probably more now the rating agency, the pressure from their indications.
And in the finance company part of your report, you've noted that the property lenders, in terms of development property lenders, are gone now. I mean, obviously the big names of a few years ago, the Bridgecorps, the Hanover's, Cavill and Merchants, etc., St Lawrence, all gone. So, I mean, who, if anyone, is stepping in to lend to property developers? Are the banks doing it? And what are the implications, especially here, for the rebuild in Christchurch?
I think that's sort of three questions in one. Firstly, who's lending to property developers are probably parties are willing to lend to property developers, but the game has changed. It can't be 5% in the game with the rest borrowed. A property developer will be lent to if what they have is a strong, sensible development that is fully tenanted, and as a result will have cash flows from the onset, and that developer has got some skin in the game. In terms of just generally, I think property developers is going to be an area that other parties will lend to when there's end user demand. In terms of Christchurch, I think that's a little bit different, because I think it's going to be essential buildings and essential type assets that need to be rebuilt, assets that will be used and will pay for themselves, and so the banks probably will want to take a role in that. But anything that gets towards the speculative end of the scale, the banks will be more reluctant to get involved in, as will any financier, to be honest, after the lessons of the GFC.
And just in terms of the Christchurch rebuild in the next few years, how significant in terms of, I guess, the overall banking and finance company sector is that going to be for credit growth? How significant a driver?
I think it's going to be very significant, Gareth, because there's enormous amounts of insurance proceeds here in New Zealand ready to be spent. You're going to see that money spent rebuilding the CBD and probably a new CBD in Christchurch, a build the likes of which we've probably never seen. It'll probably carry on over 5 to 15 years and will have an enormous impact on the economy. You know, those dollars that go in the top of the economy to start that building process will go around many times, with the builder paying subbies, the subbies having to live, and all those sort of things. So I think it'll be an enormous impact when it finally does start.
And this year you've also discussed social media and what the banks are doing with the new world of social media. How are they faring there so far, and what sort of opportunities do you think they have? And on the other hand, is there also a threat? I mean, in terms of new competitors coming into the financial services industry, a sort of a PayPal type model, or even other ones?
Well, I think those threats are always there, and I think the banks are very much beginning this journey, dipping their toes in the water, as are we to some extent in our survey. And I think it's going to be a very interesting space to watch, because if you accept we're near the bottom of the cycle and things are about to improve and go forward, banks are going to want to innovate. They're going to want to have more products. They're going to want to provide more services to their clients. And in this day and age, it'll be through the social media. Interestingly, we had a session with the CFOs and CEOs at lunch today talking about this, and they were giving an example of Kenya, where there was no banks, there was no landline, and there was a strong landline phone system. One of the mobile companies went in there and has completely changed the way they bank, completely changed the way they do phones, such that everyone has a mobile and does all of their banking through their phone. Their phone is their credit card. So that sort of change is very possible. The difference here is we have some entrenched markets with credit cards and the like. So I think that's very much going to be a watch your space.
Thanks for that, John. That's John Kensington, who is Head of Financial Services at KPMG, discussing the annual Financial Institution Performance Survey. And I'm Gareth Vaughan at interest.co.nz.